Welcome back to Principal and Profit. Look at the headlines today in 2026, and you'll see that everyone is chasing the next big thing in AI. People are buying stocks with PE ratios of 100, effectively paying for 100 years of profits up front based on nothing but hope. But here's the reality. You can't pay your mortgage with hope. You can't buy groceries with a growth projection. In this era of sticky inflation, the most radical thing you can do is stop gambling on the future and start owning the present. Today, we are building the Dividend Engine, a strategy designed to generate a $2,000 per month second salary from boring companies that make real things. No hype, no moonshots, just cash. Let's look at the numbers. In the 2010s, a 2% dividend was fine because interest rates were zero, but it's 2026. The Fed has settled at a new normal of 3.5% to 3.75%. If your portfolio isn't yielding at least 5.5% to 6.5%, you aren't even beating the risk-free rate of a government bond once you factor in taxes. To get $2,000 per month, which is $24,000 a year, the math is simple but strict. At a 6% yield, you need $400,000. If you try to do this with safe 2% stocks, you'd need $1.2 million. Most of you don't have an extra $800,000 lying around, so we have to engineer a higher yield without taking on trash debt. We do that using the Three Pistons. We only buy companies that own the pipes and wires of civilization. Piston 1. Regulated utilities. In 2026, electricity is the new oil. AI data centers and suburban electrification have made the grid a must-have. We look for regulated utilities that have a legal right to pass infrastructure costs to consumers. They are the ultimate inflation pass-through. Piston 2. Industrial and Logistics REITs, the physical internet. While everyone buys the retail stores, we buy the concrete floors the packages sit on. We focus on last-mile warehouses within 50 miles of major cities. If you own the warehouse, you own the toll booth for the entire 2026 supply chain. Piston 3. Consumer staples, the calorie floor. This is the boring stuff. Soap, cereal, toothpaste. The Allianz report shows that while luxury spending is down, essential spending is higher than ever. These companies have pricing power. When their costs go up, they raise prices, and that in turn raises your dividend income. If you only invest in the United States economy, you are overpaying as U.S. stock valuations are currently trading at a premium. To hit our 6% target with quality companies, we have to look abroad. In 2026, the geographic arbitrage is in emerging markets like those tracked by the MSCI Emerging Markets Index. While U.S. REITs yield 4%, high-quality Brazilian logistics and retail REITs are yielding around 8% to 10%. Why? Because the market is pricing in geopolitical risk that hasn't materialized. By putting 15% of your engine into these international yield monsters, you lower your required capital and protect yourself from a depreciating dollar. A dividend engine needs oil. 1. The drip phase. If you don't need the $2,000 today, you reinvest every cent. This isn't just growth, it's share accumulation. You are buying more workers for the factory. 2. Dividend growth rate. A 6% yield is useless if it stays 6% forever, while inflation is 5%. We only buy companies that grow their payouts. This is your inflation shield. 3. The One Big Beautiful Bill Act shield. Use tax-advantaged accounts to stop the invisible vampire from sucking 20% of your yield. Your net yield is the only number that matters. A $2,000 monthly salary isn't a dream. It's an engineering feat. It's the result of choosing real assets over hype. When you own the utilities, the warehouses, and the food supply, you stop checking the stock market and start checking your mailbox for checks. If you're ready to stop buying hope and start buying cash flow, hit like. Subscribe to Principal and Profit to join our mission of financial sovereignty. Comment below. What is the one boring company you'll never sell? Let's talk about it. We'll see you on the next one.